Today we are here on this webinar on a topic to organize this topic of 55th GST Council meeting, key highlights and discussions. I am Pradeep Kumar Jhajaria, Assistant Director. Actually, this moderation role was to be taken up by Joseph Goda Patil sir, Joint Director here in DGTS. But as he has been called for some urgent duty for elections in Delhi, so I'm just stepping in his place. So kindly bear with me. So right now, sir, Sumit sir, if you please allow, sir, your permission for starting with this program, sir.
Yes.
Sir, please go ahead, sir.
Thank you, sir. So today we are here with this important topic of 55th GST Council meeting, key highlights and discussions. As we always organize these webinars for better benefit of our attendees and taxpayers, today we are having four important trade panelists. Ms. Tripti Pawar, who is Secretary General HRAWI, Shri Sumit Shantilal Bohra, President IBAI, Ms. Ira Khanna, Director Tax FICCI, Shri Amar Jatin Seth, Secretary FADA. And I would like to welcome all the participants and departmental officers on behalf of the Director General of Taxpayer Services, Mumbai Zonal Unit. Now I take this opportunity that these trade panelists, they enlighten us with their wise words. And I request Ms. Tripti Pawar to address the participants.
Sure. Thank you so much. Good afternoon, everyone. This is Tripti Pawar. I'm the Secretary General of the Hotel and Restaurant Association, Western India. HRAWI is an esteemed organization, like 73 years history, focus on representing the hospitality industry. Our members include the hotels and restaurants of all types, including well-known brands like Taj, Oberoi, Leela, ITC, etc. We have around 1,500 members establishment as our member, and association represents the hospitality sector across the Western India, including Maharashtra, Gujarat, Madhya Pradesh, Chhattisgarh, Goa, and the Union Territory of Dadra, Nagar Haveli, and Daman Diu. We are affiliated with the Federation of the Hotel and Restaurant Association of India, the leading national body for the industry, which was founded in Mumbai in 1950 by late J.R.D. Tata. The association is committed to helping the hospitality sector grow by organizing the regional conventions, business seminars, and offering scholarships to the talented students. We are also closely with government bodies to address the key issues and hospitality and tourism, ensuring the industry's continued growth and success. Today, I'm here to know more about the GST implications on the hospitality industry. And this opportunity is through DGFT. I'm very thankful to them for this opportunity to our association. Thank you so much.
Thank you, ma'am. Thank you very much. Now I would like to ask Sri Sumit Shantilal Bohra, President, Insurance Broker Associations of India, IBAI, to address the participants. Sri Sumit Shantilal Bohra.
First of all, a very good afternoon to all of you, and it's an honor to be here, sharing this with all of you. So, just giving us our background. So, basically, Insurance Brokers Association of India is a 22-year-old organization. It's basically all the broker members in the country. So there are more than 700 broker members in the country who are dealing into insurance, reinsurance, life insurance, and so on and so forth, are all members of this organization. Our role is to make sure that we protect the interest of the customers, as we are, as per our articles, we are supposed to represent the customers, and that is what our interest is. We make sure that we impart enough education to the customers, to our broker members, and make sure that insurance is going to the nook and corner of the country. We also participate in making sure that the dream of our country, where insurance has to reach to all of us by 2047. So we are making all the efforts to make sure that insurance reaches every nook and corner. We've started a lot of initiatives also in terms of publishing magazines, claims handbook, carrying out a lot of education programs for schools and colleges to make sure that the representation and the knowledge is shared across the country. I'm happy to be here and would like to hear from all the participants and understand, what are the implications of GST. I am sure that, there's a lot of hue and cry which is already going on in terms of exemption of GST on health and term. So would understand, would like to understand how it's going to go. Thank you.
Thank you, Sumit Bohraji, for your kind and encouraging words. Now, I would like to invite Ms. Ira Khanna, Director Tax, the Federation of Indian Chambers of Commerce and Industry. Ms. Ira Khanna.
Yeah, good afternoon, everyone. At the outset, I would really like to thank DGTS Mumbai Zonal Unit for coming up with this such important webinar. And I'm representing FICCI today, which is FICCI is also Federation of Indian Chambers of Commerce and Industry. So it's the apex and one of the oldest chambers, and founded in 1927. So I lead the tax policy and help our members in representing the tax issues pertaining to direct tax matters and indirect tax matters with the government of India. And we engage with the government on various issues, policy matters, and the procedural issues under GST, customs, and direct tax with the government. And our membership comprises of a lot of corporate members and also small-sized members. So there's a like MSME division also within FICCI. Startups, and we have about like 70 sectors within FICCI. And so as a part of the tax division, we are representing issues pertaining to all the sectors to the government. Thank you for providing for this opportunity to be a part of this webinar. And we are looking forward to having good, really deep insights on the about the meetings of the GST Council. Thank you, everyone.
Thank you, Iraji. Thank you very much. Now I would like to invite our fourth trade panelist, Sri Amar Jatin Seth, Secretary, Federation of Automobile Dealers Association, FADA. Sri Amar Jatin Seth.
Thank you, Dr. Pradeep Kumar. It's a pleasure, I think, to be here with all distinguished guests and learned people. So FADA is a Federation of Automobile Dealer Associations. It is a nationwide body. We have close to 15,000 members across the country. Each of our member is an authorized automobile dealer of the OEM. It can be for two-wheelers, three-wheelers, four-wheelers, tractors, commercial vehicles, and throughout the country. We employ and generate a lot of revenue across the government for all sectors. Our reach is very local. So there is a dealer in a small town also. We give employment to people within that town. We, of course, are large revenue collectors for various taxation authorities. GST is a subject that concerns us deeply because I think we are probably the only industry which has tax rates from 0% to 50%. 0%, some of you might wonder why, but if a used car is sold on a loss, we don't have to pay tax on it. So we have slabs 5% for the EV vehicles, 18% for our workshop labor billing, 28% for parts, and 50% all the way from 28 to 50 if we include the cess too on the new cars that we sell. So GST is certainly a subject which we all are always engaged with. I think this type of a webinar is a great initiative. Congratulations to all of you all who are involved in organizing this, and looking forward to great learnings and listening to the next part of this webinar. Thank you for having us here.
Thank you, Amarji. Today we are having our principal ADG sir, who is chairing this webinar, and he is someone like the most towering personality in our formations, and he doesn't need any introduction. He is IRS of 1994 batch, and we are really grateful and pleased to introduce Principal ADG Sir Sumit Kumar Sir, who will be today's means keynote speaker on this topic, GST Council meeting, key highlights and discussions. And with his long experience in field formations and in different areas, means in government, we are hopeful that sir will be like the guiding torch and will be encouraging us with his wise words on this topic. So now I would like you, sir, to means give us some drops of amrit from you, sir, on this particular topic and means from your experience, sir. Thank you, sir.
Very good afternoon to all the participants. I especially welcome Ms. Trupti Pawar, Secretary General of Hotel and Restaurant Association of Western India, Shri Sumit Shantilal Bora, President of Insurance Brokers Association of India, Ms. Ira Khanna, Director Tax, the Federation of Indian Chambers of Commerce and Industry, and Shri Amar Seth, Secretary, Federation Automobile Dealers Association. It is indeed an honor to extend a warm welcome to all the participants of this webinar. I appreciate the great support and cooperation extended by HRAWI, IBAI, FICCI, and FADA. These associations have played a pivotal role in accelerating genuine grievance redressal and raising of important issues by enabling the government to address and redress the problems in the right perspective. The role of trade associations is very important, as the Indian economy is very complex, and it is not possible for the government to deal with these issues without key inputs from these associations. I would like to mention that we are a part of Ministry of Finance, Central Board of Indirect Taxes and Customs. Directorate General of Taxpayer Services is headquartered in New Delhi, and we have 6 zonal units covering the entire length and breadth of the country. Our Mumbai zonal unit caters to the entire state of Maharashtra and Goa. The directorate is set up with the mandate to reach up to the taxpayers, which include taxpayers themselves, practitioners, trade associations, to create awareness about the changes in law, rules, procedures relating to the entire gamut of indirect taxation, whether it's GST and customs and related areas, and also wherever possible to clarify the doubts arising in the implementation enforcement of new procedures. It is our constant endeavor to bring in the current and relevant topics, whereby we can facilitate trade, importers, exporters, by enabling them to become aware of these changes. And our aim is to enhance compliance. Most of the taxpayers may not be aware of changes, and that is where these associations help us in bringing these topics to our notice. Our webinars, seminars have been conducted in the past by Mumbai zonal unit. We take regular inputs from the trade. Today's webinar is one such occasion. The 55th GST Council meeting was a very important meeting, and a number of key areas have been touched in that meeting. I therefore welcome all of you to our webinar on the topic of 55th GST Council meeting. The 55th GST Council meeting took place on December 21st, 2024, chaired by the Honorable Finance Minister of India. The key decisions included reducing GST rates on things like fortified rice kernels to 5%, exempting gene therapy from GST. The GST Council also clarified that no GST is payable on penal charges levied by banks and NBFCs for non-compliance with loan terms. Additionally, the GST rate on dried black pepper and raisins supplied by agriculturalists was completely exempted, along with other very significant changes. The aim of these changes is to simplify the GST framework, promote economic growth, ensure a high degree of compliance, and get the benefit to various stakeholders. We have a very eminent speaker today, Shri R. Srivatsan, who is Assistant Director in National Academy for Customs, Indirect Taxes and Narcotics, Chennai Zonal Unit. He is a very seasoned tax professional with very impressive academic credentials, having done post-graduation in physics, electronics, and telecommunication engineering. He has a postgraduate diploma in public administration and a doctorate in taxation. He has extensive experience in policy, anti-evasion, and tax compliance. He is a visiting faculty at premier institutes. He has a publishing record of over 350 articles and has authored book on GST. He is also a very sought after speaker at various forums, and he is currently discharging his official duties being posted at NASAN, Chennai. The government has recognized his service by granting him awards, including the Best Officer Award, CBC Chairman's Commendation Certificate, and Presidential Award. So I'm sure his presentation would be very useful to all the participants. With these words, I welcome all the attendees to the insightful seminar. Over to you, Pradeep.
Thank you, sir. Thank you for your encouraging words, sir. It's your encouragement and guidance, sir, that have made us come up with these new and beneficial programs and webinars for the benefit of taxpayers. So thank you very much for your guidance and these kind words. Now I would like to invite Sri R. Srivatsanji. As sir has mentioned, he is one of the most exceptionally decorated officer in the department and has already earned himself 3 prestigious awards: Best Officer Award 1999, CBEC Chairman's Commendation Certificate 2016, and Presidential Award 2019. And sir is very kind that he has accepted our request at a very short notice to prepare this presentation for the benefit of taxpayers here. So very kind of you, sir. And now I would like to hand it over to you, sir, for your presentation. And at the end of your presentation, sir, you can go by the question and answers also if there are any on the chat box, sir. So nice to meet you again, sir. Thank you very much for accepting this invitation, sir. And I'm handing over to you for your presentation, sir. Sri R. Srivatsan, sir.
Yeah. Thank you very much. Good afternoon to everybody, and wish you all a very happy and prosperous 2025. And at the outset, it is my great privilege to extend my gratitude to the Principal Additional Director General DGTS Mumbai for having given me this opportunity to make a small presentation on the key recommendations of the 55th GST Council meeting. I would also like to place my gratitude to my Additional Director General NASAN Chennai for having mentored me on this aspect and identify the areas on which I should speak, which in fact are beneficial to trade as well as to the tax officers. So with this gratitude quotient in place, I would like to make this presentation so that it will be enriching for everybody who is part of this seminar. I will share the presentation. I have access to the chat box also. So if there are any questions in between, you're most welcome to ask the questions on the chat box. I will answer it then and there. And if you reserve your questions towards the end of this presentation, then also I will try to answer those questions. If there are some questions which probably are not possible to share it here, you can send it to DGTS Mumbai, from where the clarifications can be obtained. So I'll start the presentation by sharing this document to you. I hope the presentation is visible to everybody. So one line of confirmation will help me to.
Yes.
Okay,
Yes.
right. Okay, thank you very much. So I'll be talking to you about the key recommendations that were made as part of the 55th GST Council meeting. And as the Principal Additional Director General said, the meeting was actually held on 21st of December 2024 at Jaisalmer, Rajasthan. And there were a lot of key decisions that were taken, and most of the decisions were trade friendly. So I will be talking to you about the recommendations, which includes the changes for trade as part of the trade facilitation, changes relating to policy and procedures, changes relating to the taxability, and certain definitions have been included. And towards the end, we will also have an insight about the change in the rate of tax, which the Principal ADG also mentioned as part of his keynote address. There are certain decisions which were in fact anxiously looked forward, but those decisions have been deferred in the sense that there was a lot of talk about rate rationalization and also the rationalization of tax rates with reference to life and health insurance premiums, and also about the collection of compensation cess. But these three decisions have been deferred to subsequent GST Council meetings. So with this, let me start the presentation. Yeah. First of all, let me take the first topic, which is the talk of the town regarding the availability of input tax credit on construction of immovable properties. I think the entire country is aware of the fact that there was one very important Supreme Court judgment that was pronounced recently with reference to the availability of input tax credit with reference to construction of immovable property in the case of Safari Retreats versus the Union of India. The Supreme Court held that the construction industry should not be barred from the availability of input tax credit because of the prohibition that is made as part of section 17(5)(d) of the CGST Act, which we commonly call as blocked credits section, and they should not be available for the immovable property. The Supreme Court actually held that these properties, if they are intended to be built for the purpose of leasing out, then they fall within the ambit of the definition of plant, and therefore they must be made available. The basis for taking this decision is that the Supreme Court took cue from the fact that in case of an income tax judgment, in the case of Taj Mahal Hotel versus the Union of India, where it was held that plant included small warehouses too. Obviously, just to give you a small background about the case, in terms of section 17(5)(d), it disallows the input tax credit on goods or services which are used for constructing immovable property, with a specific exception which says that plant or machinery under 17(5)(d). The Supreme Court has said that before deciding whether the eligibility of input tax credit is there or not, we have to undertake something called a functionality test. What purpose for which these plant and machinery are built? In case the plant and machinery are built with the purpose of selling them as immovable properties, probably the prohibition under the blocked credits under section 17(5) will attract. But if these plant and machinery are built exclusively with the purpose of commercial renting as part of furtherance of business, there should not be any disqualification with reference to availment of credit, because they will fall under the ambit of the definition of plant. It also went on to say that there is a principle of tax neutrality, and therefore GST law should allow the availability of credit for construction industry also. There was also a reference that was made by the appellant where they said that it probably violated the provisions of Article 14 of the Constitution about equality before law. So all these aspects, in fact, were discussed as part of this definition. Finally, two very important decisions were made. The judgment said that the intention of having the input tax credit, which is the USP of the entire GST mechanism, is to extend the benefit as far as possible, point number one, and therefore it should be extended to construction industry also. Second is, there was also a test that was put for the constitutional validity of having the concept of blocked credit under 17(5), but the Supreme Court held that the provisions of section 17(5) is constitutionally valid, and that has been upheld, and therefore the restriction is not against the constitutional principles. It went on to say that because of the presence of the word plant or machinery, taking the constructed property as part of the definition of plant, the Supreme Court held that the input tax credit that is attributable to construction of such immovable property as plant should be eligible for them. It remanded the case back to the Orissa High Court from where it actually emanated. But subsequently, a review petition has been filed in the Supreme Court on 7th of January 2025, challenging the decision of the Supreme Court in the case of Safari judgment, because it was held that there was never any intent to give credit for immovable property. So that is exactly what 17.5C, which reference to works contract, as well as 17.5D with reference to construction industry was there. The problem emanated because of the fact that there was a presence of the word or instead of and when the definition or exception was carved out of 17.5D and 17.5C. Instead of plant and machinery, under 17.5D, it was held as plant or machinery. In 11 places, the plant and machinery words were found, and in such 11 places, out of such 11 places, in 10 places, plant and machinery is found, whereas in only one place, plant or machinery has been found, under which the Supreme Court took this decision, and it has been decided and recommended by the GST Council to amend this law retrospectively with effect from 1st of July 2017 and make it as plant and machinery for all the provisions of 17.5 as well as 17.5D. So the implications of this amendment is that probably it might nullify the Supreme Court's broader interpretation of the plant, restricting the input tax credit eligibility for construction expenses related to business operations. Probably the business also will have subsequent financial consequences. So this is in crux the entire issue or the entire dispute with reference to availability of ITC on construction of immovable property. As per the Supreme Court's decision, the plant, the warehouses, or the immovable properties which are built for the purpose of commercial renting or leasing should not attract the prohibitions extended by blocked credit under 17.5D. But because there is a proposal for amending it on retrospective basis, probably this decision could be nullified. And obviously, it has become now sub judice because a review petition has been filed by the government in the Supreme Court with reference to the judgment of the Safari retreats by the Honorable Supreme Court. So this is in crux the entire issue and the latest update with reference to the review petition. Second aspect again was which was highly debated regarding the taxability of vouchers. We all know that vouchers are part of brand promotion, or they are distributed along with supply of services or supply of goods exclusively with an intent to redeem them whenever whenever goods or services are required by the recipient of such vouchers. So the question that was put forth is about the taxability of vouchers. It was suggested that vouchers are not to be treated as supply of goods or as supply of services, and GST will not be applicable if that distribution is on principal to principal basis. So if a supplier of goods or service provides a voucher to the recipient on principal to principal basis, then such vouchers will not be treated as supply of goods or as supply of services, and no GST will be associated with that. But if there are any additional services associated with this distribution of these vouchers, like providing and advertising services or co-branding or business promotion or market support, such activities are treated as supply of services, and any consideration received exclusively for these additional services will be liable for GST. So that was the recommendation that was made by the GST Council. If the vouchers are agent-based distribution, like you appoint an agent for the purpose of distributing these vouchers, who charge a commission for undertaking this distribution of these vouchers from the principal, then such commissions will be liable for GST. So that was the second clarification that was recommended by the GST Council. Third is, what happens if the vouchers remain unredeemed? Vouchers becomes liable for tax only when they are redeemed, but no GST is payable on unredeemed vouchers, or what they usually call as breakages, and even the income booked in respect of them in the financial accounts, they are not liable for GST. There are a lot of judicial precedents which helped in taking this decision. There was one very important landmark decision taken by the Karnataka High Court, where it held that vouchers are akin to prepaid instruments as recognized by the Reserve Bank of India also. and they are not taxable as either supply of goods or as supply of services until they are redeemed. So this aspect of the Karnataka High Court has been reinforced now, and now the status is that such vouchers are not taxable if they are on principal to principal basis. Once the supply of once this taxability of the vouchers are decided not to be supply of goods and services, the presence of three very important provisions, that is section 12 and section 13 of the CGST Act, which speaks about the time of supply, and also rule 32, which exclusively deals with valuation of vouchers, have been recommended to be omitted to align with the judicial rulings as well as to align with the recommendations of the GST Council. So the impact of this recommendation will be, will be very, very helpful for the trade and industry, because it eliminates the taxability of GST on voucher transactions, and probably there is an absolute clarity with reference to such transactions regarding payment of GST. So on the basis of the recommendations made by the GST Council, a circular has also been issued recently, circular number 243, dated 31st of December 2024, which gives clear indication about when vouchers are taxable, when they are not taxable, and how the additional services that are associated with the vouchers become taxable, and when the unredeemed vouchers becomes taxable. So all these have been explained with clear illustrations so that everybody is able to understand on this subject of taxability on vouchers. So to wrap up about this particular subject, the bottom line is the vouchers are not taxable because they are not treated as supply of goods or supply of services if the distribution is on principal to principal basis. Any additional services associated with that will be liable for GST to the extent of the consideration received as commission for undertaking that services, and that concept is applicable for agent-based distribution also. And unredeemed vouchers are also not liable for GST. So these are the 4 points which are very important as far as taxability of vouchers are concerned. Next, there was a lot of difficulty in understanding inbound sales of goods by SEZ and free trade warehousing zones. We know that whenever a transaction happens inside a customs bonded warehouse, it is treated as outside India's customs territory, and they are exempted from GST until they are cleared for home consumption. A similar provision was not there with reference to SEZ and free trade warehousing zones. We know that SEZs are within the geographical boundaries of this country, but still they are treated as a place outside the country, outside the territory of the country as per the legislation in terms of Section 58 of the SEZ Act 2005. So whenever transaction happens within free trade warehousing zones, which are also treated as special economic zones, they are to be treated as outside the customs territory, and exemptions should be granted to them. But there was no specific provision for that. Now there is a proposal to include such transactions whenever they happen within this boundaries, FTWZs or SEZs. They are to be treated as neither supply of goods nor supply of services, and will be treated taxable only when they are cleared for consumption. Ultimately, whatever happens inside these warehousing zones are treated with transactions inside customs bonded warehouse, and the amendment will bring in a new provision in terms of Schedule 3, entry number 8AA, so that they are treated as neither supply of goods nor supply of services, and GST will not apply. So importers of SEZ and FTWZ will be absolutely benefited by this entry, and it is also in alignment with having a common treatment for free trade warehousing transactions with bonded warehouses, and it mitigates the tax liability, it will reduce litigations, and obviously will facilitate trade for such business entities. So this again is an alignment with whatever is already there under Schedule 3 with reference to customs transactions in customs bonded warehouses. Taxability under reverse charge mechanism. This is also a very, very important point that was clarified by the GST Council. The sponsorship services which are rendered by any business entity to another business entity were under reverse charge mechanism. That is, the person who undertakes this sponsorship service is not liable to pay taxes, whereas the recipient of the benefits of that sponsorship service will be liable for GST if he is a registered business entity. So generally, we know that the sponsorship involves financial or other support in exchange of promotional benefits for one entity to another entity. And generally, the GST rate applicable is at the rate of 18%. So let me make one point very clear. There is no change in the rate of GST for sponsorship service. It still remains as 18%, or maybe 12% for certain cultural or artistic events. The current tax mechanism, sponsorship services to body corporates or partnership firms or to registered entity, is under reverse charge mechanism, making the recipient responsible for payment of GST. What is the proposed change? The GST Council has recommended shifting the sponsorship service to forward charge mechanism, which makes the supplier, that is the sponsor, liable for paying GST instead of the recipient. So what is the benefit? There is absolutely no change in the quantum of tax to be paid, but there is a shift from the recipient to the supplier. The shift, in fact, simplifies the compliance for recipients and also allows the suppliers to utilize the input tax credit for discharging the tax liabilities and streamlining the taxation process. Because if it is under reverse charge mechanism, the recipient will not be able to utilize the available input tax credit for the purpose of discharging the liability under reverse charge mechanism. But now the process has been shifted from RCM to forward charge mechanism, where the sponsor will be able to discharge the tax liability through input tax credit available in his electronic credit ledger. So ITC remains unaffected, and it also allows the sponsors to offset the GST liability using their available ITC. At the same time, whatever is the tax that is paid by the sponsor, the recipient of such services will also be able to take that input tax credit, and this will be a win-win situation for the supplier as well as the recipient. So this is a very important change that has been brought, which will definitely help this sector of sponsorship services. Next, very important is that there is a change in the leviability of tax with reference to immovable property from 1st of October 2024. From 1st of October 2024, registered tenants are liable to pay GST under reverse charge mechanism when renting a commercial property from an unregistered landlord. So let us take an example that there is a landlord who owns a particular commercial property and he rents it to a registered entity. So the tenants are registered. In such situations, the liability to pay tax is under reverse charge mechanism on the registered tenant, and the applicable rate is 18%. There is no change as well as this rate of tax is concerned. But what happens is that if the recipient is a registered tenant and if he has opted for composition levy scheme, then it becomes cost to this company, because if a person opts for composition levy scheme, he will not be eligible for availing input tax credit on his input services or capital goods. But if a composition optee is liable to pay tax under reverse charge mechanism, shall not be at the rate that is applicable to the composition optee, but at the original rate of 18%. So the composition taxpayers for all his supplies will make charge a tax 1% to 2% according to the type of transaction. But as far as reverse charge mechanism is concerned, he will have to collect 18%, which in fact causes a financial stress for composition optees, because obviously a person who opts for composition levy scheme will be a very medium or small scale sector, where his annual aggregate turnover has not exceeded 1.5 crore in the preceding financial year. So what has been done here is that in case an unregistered landlord extends his renting of his commercial property to the composition optee, an exclusion has been carved out. GST Council has recommended excluding the composition taxpayers from the liability to pay GST under reverse charge mechanism, and as of now they are unregistered person. except for residential dwellings. So composition of these will not be liable to pay GST under reverse charge mechanism in case they hire a immovable property from an unregistered landlord. So this, in fact, scheme will encourage small and medium players to be still continue in the composition of the scheme, and they will not be required to pay tax of 18% under reverse charge, which obviously will have to be on cash basis, which would have created a lot of financial stress on them. But this recommendation will help them to avoid this blockage of cash for the purpose of paying 18% GST on the rent of the immovable property from an unregistered landlord. It has already also been stated that the past practices, this came into effect from 1st of October 2024. So whatever has happened in the past, if the composition of the has already paid, or if the composition of the has not paid, both will be regularized on as is where is basis, which means if the composition of the asset tenant has not paid GST under reverse charge mechanism, there will be a relief for him. He need not pay it again because it has been regularized on as is where is basis. But if he has already paid, he cannot obtain refund. He cannot apply for refund. So that is exactly what as is where is basis. So it has been regularized in that way also. So this again will give a lot of relief, especially the cash flow for the composition of this when they are hiring immobile properties. We also have a new scheme called Invoice Management System, which was introduced from 1st of October 2024. There were a lot of litigations under the input tax credit. We know that ITC has the anonymous distinction of being one of the most disputed subjects under GST. So why this happens is precisely because of the mismatch between GSTR 2B and GSTR 3B. There are certain situations where the auto-populated GSTR 2B does not get a validated information. There are certain situations where some information which are not applicable for the recipient is also populated in GSTR 2B, and GSTR 2B is only in editable form, only for the purpose of viewing. It does not have edit option. In order to mitigate all these difficulties, invoice management system was introduced from 1st of October 2024, where the taxpayer had the option either to accept, reject, or keep pending. So whatever happens in GSTR 2B, after reconciliation, if he feels that the such invoices does not belong to him, he has the option now to reject and recompute the GSTR 2B so that the correct and pure ITC is available in his GSTR 2B for taking it as credit with electronic credit ledger. But is it mandatory? Now they have said that it is only optional, it is not compulsory. It is a facilitating tool to ensure the virginity of GSTR 2B. Therefore, whatever is taken in the electronic credit ledger is a validated information. There is also one option that is given, like I can keep taking credit pending also. There are certain situations where the invoices would have been received but the goods would not have been received, so I can take credit only after the receipt of goods. In such situations I can keep that credit pending and subsequently take it in the next tax periods after the receipt of goods. This is just to illustrate when this can happen. So this all these aspects were introduced from 1st of October 2024. It is still optional. It is only a facilitating tool that will help the taxpayers in identifying the correct input tax credit that they are eligible for, and whatever is auto-populated in GSTR 2B can be recomputed with the reconciled information, and litigation-free ITC scenario can be evolved. So that is the purpose of invoice management system. So in order to give legislative competence for invoice management system, the relevant sections, that is section 38, rule 60, 34.2, 67B, and 39.1 have been amended so as to give invoice management system a legislative authority and framework, and this will obviously enhance the transparency, and it is definitely a taxpayer facilitation measure. So it need not be treated as a additional compliance obligation, because when you reconcile your GSTR 2B and find that all the information auto-populated in GSTR 2B are correct, if you refrain from taking any action, it is treated as deemed acceptance and the credit in 2B can be availed in GSTR 3B. So only when there is a dispute, there requires an action to be taken, either accept, reject, or keep it pending. So this will obviously help streamlining ITC ecosystem. It will ensure that only verified invoices contribute to the recipient's eligible ITC, and obviously, reduce ITC dispute and improve compliance obligation on the part of the taxpayer. So this is a very, very helpful tool for taxpayers where they are eligible for input tax credit, and whatever they are eligible are litigation free. There is one more taxpayer-friendly measure that has been recommended by the GST Council. So here, the appeals can be made with two authorities. One is with Commissioner Appeals under subsection 6 of section 107. The other one is before the GST Appellate Authority Tribunal under 129(3). We know that in terms of the disputes involve only imposition of penalty. In terms of proviso to section 6, subsection 6 of section 107, which deals with filing an appeal with Commissioner Appeals, the percentage of pre-deposit that has been fixed is 25%. This, in fact, was felt to be too large because we have harmonized this pre-deposit to 10%, not only with reference to Commissioner Bills, but also it has been extended to tribunals also. But here is the only occasion where, when there is a demand with reference to penalty alone, proviso to 107(6) imposes a condition of pre-depositing 25% of the confirmed amount, confirmed the penalty. This is now proposed to be brought down to 10%, synchronizing with the other pre-deposit requirements with Commissioner Appeals. There was no provision for making a pre-deposit whenever appeal is filed with the tribunal, appellate tribunal. So the provisions of subsection 8 of section 112 has also been amended to mandate % pre-deposit for appellate tribunals also, which was not there, which will be a new addition, which will be a new provision that is introduced, so that across the table, whether it is Commissioner Appeals or whether it is tribunal, whether it is with reference to tax or with reference to any other miscellaneous demands, the amount of pre-deposit to be paid will be 10%. So this reduction in pre-deposit obviously will lower the financial burden to all taxpayers who are appealing for penalty demands, and obviously they have improved access to justice. So this again will be treated as a very trade-friendly measure. There are also some clarifications that were issued for input service distributor. In fact, one clarification was issued way back in September 2024, where how the input service should be distributed amongst the branch agencies by the corporate office or by the head office, where it was said that the ISD includes reverse charge mechanism also, but it was restricted to intra-state transactions alone. But now, along with intra-state reverse charge mechanism transactions, interstate reverse charge transactions will also be included under the mechanism of ISD, and it has been suggested that this compliance shall be from 1st of April 2025. And accordingly, in order to sync with these recommendations, the provisions with reference to the input service distribution will also be amended in the CGST and IGST Act. So what advantage this will create? This will create a broader ISD framework. It enhances the availability of input tax credit for multi-state operations and facilitate efficient input tax credit management, where the trail of transaction with reference to distribution of credit is absolutely captured in every ISD return. So this expansion simplifies the credit distribution for business, and which especially have operations across the states. It will ensure seamless transfer of credit, not only for direct charge, but also on reverse charge, not only for intra-state transactions, but also interstate transactions with reference to common service. Obviously, ISD is not eligible for goods, it's applicable only for services. There is a new provision that is inserted, like whenever there is a liability to pay a tax or whenever there is a liability to pay interest, or whenever there is a liability to pay any miscellaneous payment miscellaneous payment like late fee, penalty, or a fine, etc. The access to the ecosystem for such players was not available because no, they are not registered persons. So now a new rule has been inserted, 16A, where no, it gives authority to provide temporary identification numbers for persons not liable to be registered but are required to make tax payments. This will be applicable for recovery of arrears under Section 79. So the idea is that they will be issued with a temporary identification number that will facilitate tax payment or any other miscellaneous payment and process the request and end the litigation. So this again is a beneficial scheme. This enables smooth tax compliance even for unregistered entities who need to make tax payments occasionally and streamline their interaction with the GST ecosystem. There is also a proposal for waiver of late fees. There was always a question like, no, I have filed my GSTR 9, but I have not filed my GSTR 9C. And in such situation, whether late fee applies for non-filing of the reconciliation statement, which is mandatory for all taxpayers whose annual aggregate turnover is more than 5 crore rupees. This late fee is imposed under subsection 2 of section 47 of the CGST Act. So the clarification is that GSTR 9 means GSTR 9C also. So if somebody has filed a GSTR 9 but has failed to file GSTR 9C, in spite of the fact that it is mandatory on their part to file GSTR 9C, here is a waiver scheme where no, the council has recommended that the late fee for GSTR 9C that is required to have been filed for 2017-18 to 2022-23 will be waived until they file their GSTR 9 before 31st March 2025. So if all the compliances are completed before 31st March 2025, the late fees associated with that, which is about 200 rupees per day, but capped at 0.5% of the turnover of the state, that will be waived off. So this move will definitely, provide relief to the taxpayers, and they encourage the timely compliance, not only but for tax period also. Now coming to another very important clarification. This clarification has been given on the basis of the request made by the Association of Hotel Industries. We had, as part of the assessment of tax liabilities with reference to hotel, a concept called declared tariff. The declared tariff will be something which is available as part of their tariff card, either displayed physically at the help desk or not declared through their websites or through any other means. There will be a declared tariff, and from that declared tariff some discount will be given, and there will also be no associated reduction in the tariff for off season. So many factors influence this hotel accommodation tariff, but the rate of tax will always be applicable only on the declared tariff and not on the amount actually charged. Now GST Council has sought to amend this definition, and the definition of this value will be the value at the specified premises and on the hotel accommodation on the actual value of supply instead of the declared tariff. So the concept of declared tariff has been proposed to be removed. The definition of declared tariff will be removed from the relevant GST notification in relation to service rates and exemptions. So now there will be only two rates. One is 18% GST with ITC if the value of supply exceeds 7,500 rupees per accommodation per night, or 5% GST without ITC if the value of supply is 7,500 or below. The taxpayers have the options, or the service providers will have the option either to take 18% or 5%, but in case they choose to take 18% GST with ITC, the hotel will have to make a declaration at the beginning of the financial year or at the time of registration, so that it helps them in taking the beneficial rate that is applicable to their business vertical. This change is proposed to be from 1st of April 2025 only, not immediately, so that it avoids the transition difficulties. So what impact this recommendation has made is that the removal of a declared tariff and linking it with the actual value of supply provides flexibility and potentially lowers the compliance burden on the hotels, and also brings down the amount of tax that is liable to be paid. This, in fact, will be a very beneficial change without having any complexities, but pay tax on the actual value that is charged for the supply of accommodation services. Next is there was a lot of confusion with reference to taxability of used cars. Let me first demystify one of the very important aspects of this used car transactions. It is always misconceived that whenever the used cars are sold, it always is on the selling price. The answer is no. The transaction value with reference to used cars is on something called margin money, and margin money is nothing but the difference between the selling price of the used car minus the purchase price. Selling price from in the hands of the supplier, buying price by the supplier. So if that difference is positive, then GST is levied on that. If that difference is negative, positive margins attract GST while negative margins do not attract GST. And there is another misconception where it is believed that the rate of GST has been completely increased from 5% or 12% to 18% for all transactions. Again, this is only a myth. It requires to be demystified. We will have to understand the fact that previously also all old vehicles were taxed at 18%, which excluded electric vehicles and small vehicles. Small vehicles are those decided on the basis of the engine capacity and also the ground clearance. So now, in order to harmonize everything, this exclusion has been removed. Which means all old vehicles will now have a harmonized rate of 18% on the margin value. So as I said, margin value is the difference between the selling price minus the purchase price. So if the purchase price is more than the selling price, then there is no value addition in the hands of the second-hand dealer, and no GST is liable to be paid. And another aspect is, I'll go to the earlier slide. This slide also will give you some more insights on this second-hand car transactions. When the transaction is between an unregistered person to an registered person, they remain non-taxable, just as it was before. When the transaction is between an unregistered person to a registered person, also there is no scope for payment of GST, because the unregistered person is not doing it in the course of furtherance of his business, and that is how it has to be treated. This impact will be predominantly on the resellers, especially a registered person, second-hand dealer, to an unregistered person. So registered person to an unregistered person will attract 18% tax. So this is how it has to be understood. So all the myths that are associated with that requires to be demystified. And obviously, the implementation of this uniform rate of 18% on the used vehicle will ensure clarity and consistency in taxation on the margin earned by the dealers. So there will not be any differentials between EVs and small vehicles. All attracts 8%. So this is not sudden increase of 18%. It is only the exclusion that was already there has now been removed. Next is there are a lot of debate with reference to ready-to-eat popcorns. So let me not go into the controversies associated with that. Let me give you a clear understanding of what rate is applicable for which type of popcorn. If the popcorn is non-pre-packed, unsweetened popcorn, it attracts 5%. If the same unsweetened popcorn is pre-packed and labeled, it attracts 12%. If it is caramelized, which contains sugar confectionery with an essential characteristic of sweetness, it attracts 18%. So you will have to understand that a clarification has been given as part of the recommendation. There is no change in the rate of tax. These tax rates were in existence earlier also, but the idea of making a recommendation is to provide clarity and ensure consistent application of GST rates on popcorn based on the composition and the packaging. So that is exactly what will decide what is the rate of tax, and there need not be any confusion on this. There are 3 rates, 5, 12, and 18. based on their composition and also based on the packing. Let me now dwell into the other changes in the law. So this might be a little bit too technical, but still, no, they are extended with the intention of helping the taxpayers. So the composition of this can now, give a specific category of the registered person. Earlier, there were only 3 options. Where, you can see here. I just show it also. Yeah. See, while applying for GST registration, there were the category of registered person will be like this. So he would have, the person who has opted for composition levy scheme and is under GST CO CMP 02 would have mentioned any of these 3. Now, he has an option to amend that, and they can change their category of registered person using form GST REG 14 also. So this will give a greater transparency with reference to their transactions. Next, very important, which in fact impacts the automobile sector, is availability of input tax credit on X works. There are a lot of transactions by the original equipment manufacturers where the sale is on at the factory gate. The cars which are manufactured by OEMs are sold according to the contract at the factory gate, so that the right of ownership and the right of possession are changed from the manufacturers to their dealers right at the factory gate. The invoices will reach the dealers well ahead of the goods that are supposed to reach their godown. In such situations, there were a lot of difficulties for the dealers to avail input tax credit, because one of the conditions according to section 16(2)(b) is that the input tax credit can be taken only after receipt of goods. So there were a lot of litigations there, even though the right of ownership is transferred at X works, till they reach the principal place of business or additional place of business of the distributors or dealers, till such time the credit cannot be taken. So that was the litigation that was going on for a long time. Now, the GST Council has recommended, and on the basis of the recommendation, the circular also has been issued, circular number 241. The crux of the circular is that it emphasizes that section 16(2)(b) of the CGST Act does not specify a particular location for receiving goods, but only insist on receipt of goods by the recipient of supply. This brings in a concept called deemed receipt. So in situations, though not defined in as many terms, they play a crucial role in availing input tax credit instantly at the exports. So now when the goods are delivered to any person under a registered person's direction, whether through a document transfer or by any other means, it constitutes a receipt for the purpose of input tax credit, and immediately the recipient can take credit, notwithstanding the fact that they have not reached their principal place of business or additional place of business. In such situations, it is treated as deemed risk, and the clarification gives a lot of scope for availing input tax credit without any litigation in such transactions involving change in the right of ownership or possession X works, where the supply is recognized. Other changes in law, GSTR 2B and GSTR 3B now has been sequenced. So the provisions of section 39, which deals about the complaints obligation for filing GSTR 3B, so it will now be amended to provide that form GSTR 3B of a tax period shall be allowed to be filed only after form GSTR 2B is generated for that particular tax period on the portal. So this will help the taxpayers also to avail the exact amount of credit, because before filing GSTR 3B, GSTR 2B will be available for them to reconcile. And now with IMS also into place, the reconciliation work can also be undertaken, and litigation-free input tax credit can be availed by every taxpayer. There are other miscellaneous clarifications also which has been made. In fact, the first clarification was mentioned by the respected Principal Additional Director General during his keynote address. GST is not payable on penal charges levied and collected by banks. There was a dispute whether to treat it as consideration for refraining an act and treated as supply of services. But now it has been recommended to be clarified that penal charges are outside the ambit of the levy of GST, probably equating them along with the liquidated damages to some extent. Then e-commerce operators who operate both under reverse charge mechanism as well as under forward charge mechanism. For instance, if an e-commerce operator undertakes food delivery, then the liability to pay tax is under reverse charge mechanism. For instance, if Swiggy delivers a food parcel, it is treated as a restaurant service with reverse charge mechanism. And they are also into delivering a lot of pre-packed foods also, where it's not treated as a restaurant service. Like they deliver a sort of condiments or like a Haldiram's sweet or something like that. In that situation, they are not treated under reverse charge mechanism. The liability is on forward charge mechanism. So in such situations where there is a mixture by the same entity to have a reverse charge mechanism as a restaurant service, but at the same time also have forward charge mechanism for some other operations, when they choose a marketplace model, there will always be a conflict in terms of section 17.1 and 17.2, where they are liable to reverse the tax because either they are under reverse charge mechanism or some aspects are under exemption. So now a circular 240 has been issued on the basis of the GST Council's recommendation that such e-commerce operators are not required to reverse the input tax credit under 17.1 or 17.2, even though they have a reverse charge liability under section 9.5 of the CGST Act, where they act as providers of restaurant services and pay taxes on behalf of the actual restaurants. So this clarification will help mitigate the e-commerce operators from the obligation to reverse ITC in respect of reverse charge transactions. Supplier of online services, in fact, if it is an OIDAR service, if the supplies are received by unregistered person, the unregistered recipient, then the name of the recipient state on the tax invoice has been made mandatory. For instance, if you go and book a ticket in IRCTC, the tax invoice does not explicitly show to which state the recipient of such service actually is located. But now, for all such online services, which includes online money gaming, OIDAR services, or any other supply of services online, the recipient's address on record shall determine the place of supply, and there has to be a specific mention about the name of the recipient state on the tax invoice. So this has come as a compulsory obligation for all the taxpayers to make online supply of services. This has been clarified on the basis of the recommendation of the GST Council under circular number 242. So that can be referred, which gives a detailed information about that. There is also one mechanism called track and trace mechanism, which is likely to be included as separate provision. Section 148A is likely to be included, especially for those goods which are specified as evasion-prone commodities like tobacco products. So where this track and trace mechanism will be put in place, a unique identification marking will be provided to ensure effective traceability of these commodities across the supply chain, right from the originating point till it is consumed. So this legal framework will help tracing of such specific commodities across the supply chain where they go. Because this effort has been made because according to the Tobacco Institute of India, it has been estimated that the government loses about 21,000 crore rupees per year due to illegal cigarette trade. So in order to mitigate this illicit transactions, probably this track and trace mechanism will be put in place, and the trail of movement of such goods to trace them across the supply chain will help to mitigate the evasion in this particular commodity or particular sector. Some rate changes that has been proposed is, this was also mentioned as part of the keynote address by the respected Principal Additional Director General, to reduce the GST rate for fortified rice kernel from 12% to 5%, exempt gene therapy, that is with an intention to protect from life-threatening diseases, which gets exempted, and exemption is extended to systems and subsystems and equipments for long-range surface-to-air missile under notification 19 of 2019. reduce the compensation cess to 0.1% and treat it on par with merchant exporters, where for merchant exporters, the GST applicable is 0.25 plus 0.25%. So this will help to bring it on par with that. To exempt from IGST import all equipments which are intended as part of the inspection team of the International Atomic Energy Agency, subject to certain specified conditions. And to extend a 5% GST rate for all food preparations that are intended to be given free of distribution for economically weaker sections under the Government of India program. And also this is very important as far as insurance companies are concerned. The general insurance companies which have this third-party motor vehicle premiums collected by them under the provisions of Section 164B of the Motor Vehicles Act. This fund constituted for providing compensation and cashless treatments to the victims of road accidents. So this amount will be exempted from GST. So this is one very important for insurance sector, especially motor vehicle insurance. To clarify that autoclaved aerated concrete blocks having more than 50% of fly ash content will attract only 12% GST. This again is a reduction. And to clarify that the fresh green dried pepper and raisins but when supplied by agriculturists will not be liable for GST. And also to bring in all commodities pre-packed and labeled that are intended for retail sale and containing not more than 25 kgs or 25 liters as defined under the Legal Metrology Act. At present, there are only specified commodities like cereals, grains, dairy milk, dairy products, milk products, etc., flour pulses. But now with this recommendation, all commodities that are covered under the Legal Metrology Act will be covered. There are some policy matters which are also discussed as part of the GST Council's meeting. Procedural rules that is proposed for internal functioning of the much awaited GST Appellate Tribunal would be notified after it is finally examined by the Law Committee. So means that we have light at the end of the tunnel. Probably the GST Appellate Tribunal will be formed very, very shortly at any time. So almost everything that is required for putting in place GSTAT has now been completed. Probably it remains to be notified and then bring such an organization as part of the dispute resolution mechanism. So this is something which is much awaited by all taxpayers. I think we have almost seen the light at the end of the tunnel now. To extend the time frame for a group of ministers on restructuring of GST compensation till 30th June, rate rationalization. Then there was also a discussion in the GST Council to bring in the aviation turbine fuel as part of GST, because we know that there are 5 commodities which has been kept outside the ambit of GST: crude, petrol, diesel, compressed natural gas, and aviation turbine fuel. So there were a lot of pros and cons. There were a lot of requests by states and also opposition by the states to bring in these commodities. It was suggested that aviation turbine fuel can be first, as a first step to bring petroleum products as part of GST, can be notified, but still a decision has not been taken with reference to that, because still a lot of opposition is there from these states to bring in these petroleum products. There's also a lot of disputes with reference to food delivery charges, especially by e-commerce operator. So a decision that also is likely to be taken shortly. Then a group of ministers has been constituted to examine legal and structural issues on imposition of levy in case of natural disasters and calamity in a state. We remember a couple of years back where Kerala was hit by a severe earthquake and floods, and therefore there was a suggestion by Kerala to impose a calamity cess for mitigating the revenue that is required to spend for restructuring of the calamity hit districts. Similar proposal was made by Andhra Pradesh also, because a lot of states have faced natural disasters this year, like cloudburst or flooding or earthquake or things of that sort because of natural phenomenon. So there was a suggestion that was made to examine whether we can have a levy in case of natural disasters, but that decision also has not been taken. It has been left to the group of ministers. And finally, the much awaited decision reduce the tax on health and life insurance. This has been deferred because one of the reasons stated for deferring this is that a final recommendation or final report that was sought by IRDAI is yet to be received. Once it is received, I think probably a final decision will be taken on that. Till such time, the GST on health and life insurance will continue to be at the rate of 18%. So, yeah, we can understand that there are so many changes that requires to be meticulously analyzed. Nevertheless, all these changes were in the interest of trade facilitation and also with an intention to synchronize them with the economic compulsions of this country. Importantly, recommendations of the GST Council will be given effect through various relevant circulars and notifications and law amendments, and only after that any change in the legislation will come into force. So these are still on the recommendatory stage. There are certain clarifications that has been issued, which takes effect immediately, but all the legislative will come in place only from the date to be notified later. So with this, I will conclude my presentation. So the presentation, as part of the presentation, I discussed about the changes that will have impact on trade facilitation and policy and procedural changes, taxability of certain transactions, change the definition, especially this input service distributors, rate changes, and what policy matter change that can be expected for future. So I conclude my presentation. I once again place on record my sincere gratitude to the Principal Additional Director General, DGTS Mumbai, for providing me this opportunity, and also Team DGTS Mumbai for having facilitated to make this presentation as part of an online session. Thank you very much. I will leave the floor for discussions and questions, if any, that can be asked. So I'll stop sharing my.
Thank you, sir. Thank you very much for this elaborate and excellent presentation and throwing light on this fine aspects of this topic, 55th GST Council meeting, key highlights and discussions. And thank you for the clarifications that you incorporated in your presentation, because that was really very helpful to understand the fine tuning of the things that came up in this particular. We here in DGTS always try to reach out to different associations and trade bodies so that maximum number of taxpayers can receive the benefit of such programs. These are like educational and informative programs, so that maximum taxpayers can have the benefit of such webinars, and sometimes when we have the physical seminars also. So today in this process, we have touched upon these 4 associations. To Ms. Tripti Pawar, Secretary General, Hotel and Restaurant Association, Western India; Sri Sumit Shantilal Bohra, President, Insurance Broker Association of India, IBAI; Ms. Ira Khanna, Director Tax, the Federation of Indian Chambers of Commerce and Industry, FICCI; Sri Amar Jatin Seth, Secretary, Federation of Automobile Dealers Association, FADA. And we are really thankful and grateful that they joined this program today, and must have passed the information to their members out there, so that a maximum of them could have also joined and got benefited from this particular webinar, which was having so many areas, having concern and relevance to their field of business, and GST implications for them. And right now, I would like to have permission from Principal ADG sir, Sri Sumit Kumar sir, to give the vote of thanks to them and just conclude this session, sir.
Yes, we can conclude this.
Thank you, sir. And to conclude, now I would like to first of all thank all the trade panelists and the participants who have joined this program, and my heartiest congratulations and thanks to Srivatsan sir, who really came up with such a beautiful presentation and such elaborate and incorporated with clarifications. And thank you very much, sir, for coming up with this good presentation. And hopefully every participant got benefited by this program. Thank you very much, sir. Thank you to all. Thank you very much.
Thank you, Principal ADG, sir. Thank you, Srivatsan ji. Thank you so much.
Thank you, everyone. Thank you.
Thank you, madam.
Hira madam, Trupti madam.
Thank you.
Thank you so much.
Yeah, thank you so much, Amarji.
Thank you, ma'am.
Sumit Bora, sir. Thank you. Yeah, we are ending the session. We need to